Hello, everyone. Here we are for today's presentation, live presentation, I might add, of Derek Invests. I thought it might be worthwhile to discuss what market tops, what market corrections have in common, how to identify them. And I thought it's really pertinent to talk about it now, since we are now a little beyond kind of the election phase. So at first everyone's really excited when someone gets elected, and then other people are really depressed when someone gets elected. There's a lot of emotion around it, and now that some of that emotion has died down a little bit, I thought it would be worth talking about a market that's up about 100% in the last couple of years. If we can pull up a chart and check exactly. In fact, if you want to have a look, we can look real quick together. I'm going to start instituting not just Converse charts into my live broadcast every day. I'm going to start to institute some of both. So what we're looking at, if you go back weekly, let's whoop, 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 whoop. Let's zoom in there. So you're looking at 250 to 500 on the Nasdaq, on the Qs. We're just simply doing kind of a notional where are we at. So on the Nasdaq, you're up about 100%. On the S&P, let's see, your lows down here around 350. You're at 600. So you're I don't know, 70%. So you're up 70% in the S&P. The Dow is up from the lows of 287. It's at what's that, 439? 439, so 440. So just call it 288, 440. That's probably up about 50%. Traditionally, how far do markets rise? Well, I can tell you the NASDAQ from the lows of 2020 to the highs of 2021, which were about a full year. It was about where we sit right now. So, as far as a basis, right now, we're definitely in a place that a correction would come, or there might be a market top or something like that. So, from just kind of a notional idea of is it possible? Yes, it most certainly is. Now, let's go ahead and discuss some other major factors that come into market top. So, first, especially if you've listened to me for any length of time whatsoever, one thing that you know is that I kind of break the market up into two separate participants. You have the professionals within the marketplace. So they have a lot of knowledge about how the stock market, this includes the crypto market as well. You'll hear me talk a lot about the crypto market too. The crypto market is an asset that is included in everyone's portfolio. I hope it's included in everyone's portfolio. So you have your stock market assets, your traditional finance assets. You have your crypto assets, which now they are another market, but they're also kind of, it's all intertwined at this point, right? Because now you have funds buying crypto to drive the price of their fund. It's a funny little circle. Everybody's talking about it now as though it's a pyramid scheme. If you're not familiar with what I'm talking about is symbol MSTER. Effectively, what they do is they use the price rise in crypto to buy more crypto to help that fund go up in value. So if you look at that fund, MSTR, it seems to rise more than the currency Bitcoin. Bitcoin's not a currency. I don't want to start saying that. The price appreciation in MSTR tends to be more than the actual value increase or the price increase of the underlying asset, which is Bitcoin. And that's because they're able to use the price rise in Bitcoin. So they're using the price rise in MSTER to buy more Bitcoin. When they buy more Bitcoin, the price in MSTR can go up higher. So it's I don't want to be the one to say it, but if crypto begins to fall, or if Bitcoin begins to fall in any significant manner, I would have to think, based off how I know assets work, how I know funds work, that MSTR is going to get annihilated. So we kind of, the point of that whole, this world now where crypto is an asset class unto itself, Is it its own market? Is Bitcoin its own market? I don't know. I mean, it was. I mean, most people would talk about crypto, Bitcoin, all that stuff's over there with blockchain and NFTs and all of that stuff. It's all over there. And then traditional finance is over here. It doesn't really seem to be that way anymore. That asset is definitely over in traditional finance, and a lot of people in traditional finance now own it. So I want to talk about it more as like its own sector or its own industry, more so than its own like its own thing, its own market. I realize it is, but if you heard my explanation, you can see where I'm coming from. So we have that asset now in these worlds where the people run these markets. So they're the businesses that run these markets. We're going to call those the professionals. The professionals because they care what happens on a day-to-day basis. In fact, they care what happens on an hourly basis within these markets. So they're the professional group. And then we have what we call the retail group. That is people that they care too. I mean, their 401ks are tied up in it. Their IRAs are tied up in it. Their Roth IRAs, their children's education is tied up in it. Some people even get is tied up in it. Your insurance is tied up in it. Therefore, your home is tied up in it. I mean, so this all works together, right? We're all in this thing. But the retail investor most likely could care less what happens hour to hour. They don't care, even day to day. I mean, the average guy, barring a 50% stock market drop, barring that happening, even if it rebounded in the same year, that 50% drop would mean a lot to people. It would have a huge impact. I talk about this stuff every day. But retail, they're okay. They're not looking at it hour to hour, and they for the most know a lot of the intricacies in how these markets move, and they don't care. So if you have these two groups of people, both of them have to buy and sell positions though, right? So if you have a 401k and you're putting money in every month, odds are you've allocated your money to the growth fund or the conservative fund or the high risk or the medium risk or whatever it is that you call it, but you allocate money there. So every month money goes into that fund, and your company is also matching that as well. So you do care on a day-to-day, month-to-month basis what happens within the market because you're putting money into it. Now, as far as so you have to place trades, whether you're actually placing trades or not. If you have if you're dollar cost averaging in, meaning you take money out every paycheck to go into whatever, your own IRA, a Roth IRA, any sort of retirement account, you are actively trading, right? You are buying all the time. And then there's the professional group. They're buying all the time in a very different way. So they're buying each day in and out. And so where that starts is with your market makers. Your market makers are the guys that create all of our ability to buy and sell within markets. How do they do that? They do that with options and futures. They do it with derivatives. So there's this whole underlying current of derivatives, and those derivatives are then traded to reduce risks because the market maker is creating this market, and his job is to spread the risk out so that his firm is left with no risk. That's the goal. Every firm would like to have all upside markets, right? They create them. So you have those guys at the bottom. And if you ever have any interest, when people say, you'll hear the word they a lot. I'm not a big user of the word they. I know who they are. I hear them talk about they, them, as in big institutions, as in the professionals, as in the more knowledgeable hands, big money, smart money. People use a lot of terms. If you're ever curious in what they actually do day to day and why markets move the way they move on a day-to-day basis, I know an ex-market maker. He was a market maker for a couple of decades, nearly a couple of decades. There he is there. He's an affiliate of mine, a friend of mine. He's in the business, and he actually teaches people about that undercurrent, about the flows of the market, about what they do to a market, where you can expect price to go based on whatever this market maker is doing, or based on what that whale has done, or based on some sort of an options chain. He teaches you that stuff, and if you use the code Derek10, DEREK 10, you will get a 10% discount on everything that goes on over there at Vol Signals. If you're not following him on Twitter, you should. It's at Vol Signals. There's a lot of information there. It's a great resource for you if you are trading or investing, and maybe you are good at trading and investing. Maybe everything I've set up into this point doesn't even apply to you. And if that is the case, then this is your next step, because you can learn about what they are doing every day and what the whales are doing every day and the big orders that come in. I show people how to identify those big orders through trading activity, through volume that shows up nearly immediately on any chart. But if you want to know the exact orders, if you're one of those people that's detail oriented, head over to volsignals.com. Use coupon code Derek10, DEREK 10, and you'll get a 10% discount on whatever you're looking to learn over there, whatever programs are going on. So back to our story. You have these two groups of people. They both buy and sell. Now, what do you think the biggest difference between the buying and selling of the group that runs the Wall Street machine, the professionals that are in there every day? What do you think the biggest difference between these two people are? Now, the first thing that comes out of a lot of people's mouth is, well, the main difference is going to be that people have all the information or inside information, or they know something that these people don't know. Now, they might know a little something more than what these people know as far as like news, or maybe some bill coming through, or some of those guys are pretty high up, pretty wealthy. They probably have a lot of friends in high places and they're hanging out in the same clubs. And so maybe they do overhear something. It's possible. Is that on a regular basis? No. Do they know more about the markets than these people? Yes, but I can tell you, and anybody that's 40 plus can tell you, sometimes knowing more hurts you than knowing less. Sometimes knowing too much hurts you. You almost know so much you don't know what to do. Whereas if you stick to the basics down here, you'll know what to do pretty darn quickly. So I don't know if that matters. I don't know if that's the greatest influence. I don't know if that makes the biggest difference. But I know this. These guys over here, your professionals, the people doing things every day, all day, they leave a much bigger footprint than these people. The order these people put in, the amount of orders these people put in, compared to the order this person puts in, or the amount of order this person puts in, there's a big old difference. This is big, and this right here is small. I'm just telling I'm little. It's true. It's true. This they're going to leave a big footprint. So one of the things that I talk about all the time when you're looking at, are we at a market correction? Are we at a market high? And I say, well, what kind of investor are you? Oh, I'm a long-term investor. It's for my retirement, but I'd like to avoid the big bear markets if I could help it. Okay. So one thing you can look for on a chart, one thing that will show up all the time is volume. Volume is trading activity. Okay. So people say, well, how do you know what kind of volume it is? How do you know if it's buying or if it's selling? Because it doesn't say, right? It just shows up as volume. Well, let me ask you a question. So we started off talking today about how tops are formed and what they look like, and historically what they look like, and what have they looked like most recently, which would have been that correction that started back in December 2021, where the NASDAQ came down 35%, the S&P came down somewhere between 25 and 30%, and the Dow was down somewhere between 20 and 25%. When you look at that and you look at where they ran up since 2020, we're at about those levels now. Then you say, okay, well, what's something else that traditionally accompanies a market top? Well, something else that accompanies a market top is high levels of optimism. Everyone's excited. Nobody is worried about the down. So nobody's worried about prices falling. Every dip is a buy. This stuff goes unquestioned. Even people online that you're used to seeing some negativity from, they get out of there. There's no more negativity left, right? Extreme optimism. Do we have that? I would say that yes, right now we do have that. I would say we have very, very high levels of optimism. Okay, so what else do we have going on right now? Well, we just had an election. Okay, so in previous elections, what's happened? Well, in previous elections, you have some volatility. That means ups and downs before the election. But, I mean, truly, the next day, the market tends to take off and keep running, typically through the first couple weeks of December. Do we see that happening right now? We do. We do see that happening right now. Is it the first couple of weeks of December right now? No, we're not even to Thanksgiving. Is this a good way to buy and sell your investments? No, We're just collecting some evidence here. We're trying to figure out. So we know that these guys make a really large footprint. We know that these guys make a much smaller footprint. We know that optimism's at a high. Okay, so the election usually, following an election is usually an up market and it's pretty smooth sailing. We also know there's a such thing called seasonality. So you got the Santa Claus rally on your side, right? What do you have working against you right now? Well, something else you have going on right now is corporate buybacks. What is a corporate buyback? A corporate buyback is when a company comes in and they buy back their own stock. Well, why can that be very positive for a stock market? Well, it creates artificial purchasing. They're buying their own stock back. So in essence, they're pulling supply off the table while creating demand, because they're creating the demand. They're buying. They're creating the demand. They're removing supply, which should lift stock prices. So we have that going for us. What we have, I guess, going against us is the fact that markets do seem to have run up pretty high without any sort of major correction. I mean, I think the Dow a couple of weeks ago had a correction of about 4%, but since then we haven't, and the NASDAQ really didn't do anything, and the S&P didn't do anything. So that's not really a correction. So I guess we have a run up and we don't have big correction. Oh, something else that you'll often see before at market highs, market tops. Last week, we had a ton of inflow into the U.S. stock market. So a lot of cash came in, right? Went into funds. We have a lot of cash coming into funds. But guess what? We had a lot of cash that actually came out of two sectors, two very specific sectors, technology and energy. So a lot of money came out of those two sectors, but went into the stock market. Well, those sectors happen to be your market leaders right now. So those are your high flyers, right? That's your AI that's in the tech sector. That's I don't know that you would say that semiconductors, I guess. I mean, that's still tech, though. It's still tech. So you have semiconductors, you have your AI, and then you have money being pulled out of energy. So the fact that money's coming in, but it's leaving your risk assets, well, that can mean something, I guess, but maybe that's market neutral. I don't know. At this point, it's just information, really. So what I want you to remember is how I started this conversation. All right. And I'm going to show you what you would look for right now if you were an investor and you were saying, hey, when should this correction start? What will be the signal that this correction has started? And it's pretty easy because you want to find a bunch of trading activity, because if there's excessive trading activity and the market's at a high price, it's most likely selling. If the market's at a low price, it's most likely buying. Why? Because these professionals that make huge footprints, they buy low and they sell high, right? So let's go ahead. Let's jump over here. Let's share the screen again. All right. There we go. Run a weekly chart. So let's take a look at what it looks like when you have selling at a high. Okay. So in fact, let me go like this. That's actually, let me get that off the page. Whoops. Okay, so back here, you have June of 2020, all the way on the left-hand side back here, you have June 2020, and then all the way over here on the right-hand side, you have today, all right? Now, what you have right here is volume, okay? That's volume. I'm sorry, the sun is an amazing light source, but also can make it pretty tough to see. So there you have your volume. You basically have it at the high. January, look, January of 2022. That's effectively the market high. All right. The market falls directly after, and then it bounces up to where we are today. So if looking for something like that, if we are looking for something like this to indicate a large market drop, do we see that right now? I don't see that right now. So now I go much, much deeper than this which will bring me to my next point. What I want to show you is a very simple evaluation of, are we headed for a stock market drop right now that has a major consequence, that is going to mean something, that is going to have a high probability of you losing anywhere from 25 to 35% of your money. Right now, what we can say is, based on the Dow in 2021, no. Let's take a look at the NASDAQ. I almost jumped into the next piece already, and I don't want to do that just yet. So this is the same chart, same time frame. Now, the NASDAQ actually started pulling down before the Dow did, but as you can see, your major volume came in the exact same week. And once again, after a 100% market run up from 2020, right now, we're up about 100% from 2022. This is your bottom right here, which is 2000. Now, if we are looking for volume that resembled something like that, which let's show you how high that volume is compared to the rest of the volume on this chart so you're clear. It's up there. Do we look anything like that right now? No, we don't. So that means that major institutions, there's not a lot of trading activity, not a lot of buying, not a lot of selling, not a lot of anything in the NASDAQ. It looks like business as usual. So I would say it looks like business as usual. Now come back over to your S&P. Here we go. Same area again. It'll be the same week again. Right there. This is after about a 75% run up. Oop. I got to do that again. That's after a 75% run up in price on the S&P 500 from the 2020 lows. Okay, there you are. So if we're looking, once again, we're looking for that kind of volume. And by the way, it took place on the same week and all three indexes. And here we are today. Let's go ahead and do what we did on the NASDAQ. The NASDAQ, there's our volume right there. So how far away are we from that volume that caused about a 25 to 30% retracement, correction? Well, we just don't have anything like that. That we can say for sure. There's nothing there. Now, I'll tell you, I'm going to jump back over to the screen here. I can tell you in my experience as someone who's been in the markets for 25 years that some things are always going to show up. Some things have variables. So sometimes a pattern trader, a good pattern trader can probably identify when a pattern is valid and when a pattern is not, right? For someone like me, I know patterns. I know head and shoulders. I know wedges, right? I probably don't use them as effectively as someone who uses that tool to trade every day. So let me say this. There are certain patterns that they trade. There's adjustments. There's nuances. You have to understand certain dynamics to be able to use them, okay? To be able to use an options chain appropriately, you have to be able to use it. You have to know how to use it. You have to understand all the intricacies that you're working with. Or sometimes it can look this way and then look this way again, and it'll have completely different results. The truth is you didn't know enough. Let me tell you something. You don't need to know anything to understand volume. When there's a ton of it, it can only be the people that can make big footprints. The people that make these little footprints back here, they can never do this. They can never do that. Never. The most they can hope for, is probably that. They can never do this. So if this shows up, this is not in question. This is institutional stock market professionals making very, very similar moves in a very, very similar price. And these guys back here just have to know where to look. All right, so I have one more thing. I'm going to lead you with a final thought here, and that is that I have my intermediate trading, investing, and forecasting course that digs a heck of a lot deeper into the subject of identifying institutional money. And then let me find the coupon code here. It's intermediate 5. I'm just trying to put it up for you. This digs a heck of a lot deeper into the subject of what institutional money is, what big money is, how to identify it, how to know whether it's buying or selling, how to know where price is most likely heading, how to know how to use time frames. How do you know what time frame you're looking at? Okay, great. So we see this giant footprint hit the screen. When does it take effect? How do we know when to sell? In fact, what do we use to hedge? That's what my intermediate trading and investing and forecasting course is all about. Okay. I have it discounted 95%. It's going to be today through midnight. I said since the outset of this on Sunday, it was going to be until I got 1,000 purchasers or until Tuesday at midnight. It looks like it's going to be Tuesday at midnight. I wish I would have had 1,000 purchasers, but it's going to end up ending tonight at midnight. If you haven't picked this up, pick it up now. You won't regret it. Identifying tops, identifying bottoms, how to identify these feet print, how to know when it's a big footprint that you're looking at, how to know the time frame in when it should be happening, how to know when to hedge, when should you be cautious, when is their strength, when is their weakness. Okay, I don't want to go on and on. I want to thank all of you for tuning in. I always appreciate anyone that takes the time out of their day to hear what I have to say, in hopes that maybe I can teach them something and that they would give me that kind of time. I'm glad to do this. I'm always happy to do it. So anyway, I'm going to be back later today, and I'm going to be talking about what does it mean if we dismantle the Federal Reserve. So there's a lot of talk online right now about what it means if we dismantle the Federal Reserve. So I'm going to be talking about that a lot here this afternoon. I'll be back on at 5 p.m. Pacific Standard Time, Pacific Daylight Time, or 8 p.m. Eastern Standard Time. Sorry. 5 Pacific Daylight, 8 o'clock Eastern Standard. And once again, thank you so much for joining me. As always, I appreciate it. I hope you learned something. If you have some questions, please reach out to me, DM me, shoot me an email. So again, my course, let me put it back up. I'm going to put it back up one more time. Actually, you know what? Here, I'm going to give you my email address. So if you don't follow me on Twitter, it is Derek Invests on Twitter. And then my email address is dmiller@prometheaninvesting.com. If you have any questions, or maybe you're looking to do some one-on-ones with somebody, you're looking for one-on-one coaching for your investments, or you just want to learn how to identify price, you want to learn how to identify tops and bottoms, but you want to do it on a one-on-one basis, more focused on you and what you're doing, shoot me an email, dmiller@prometheaninvesting.com. Until later today, when I am discussing the Fed, I will be talking about what it might look like if the Fed Reserve was dismantled. I guess there's some talk that Trump has mentioned he's going to dismantle the Fed, or he's going to, I don't know what he's going to do because it's a private company. I'm not sure how you do that, but we're going to talk about what the consequences or the benefits might be of dismantling a Federal Reserve inside the U.S. All right, everyone. Thank you so much for joining me. Remember, guys, keep it good up here. If you're not good up here, you're not good anywhere.